Hello and welcome. In this lecture video, I'll be talking about comparing depreciation methods, partial year depreciation, and changes in estimates for depreciation, as well as reporting depreciation on the balance sheet, okay? So we look at this table right over here, this figure, and this compares depreciation for straight line, units of production, and then double declining. And you can see down here that the total amount of depreciation for each method is the same. It's $9,000 for straight line, $9,000 for units of production, and then $9,000 for double declining. But what changes is the amount of depreciation recognized each year. Straight line recognizes $1,800 a year. It's the same amount of depreciation expense every single year. Units of production, on the other hand, recognizes depreciation expense as a function of the units, as we saw back with that method. Double declining recognizes more depreciation expense in the early years of the asset's life, okay? But total depreciation expense is the same across all methods. Let's talk about partial year depreciation. So what we've been assuming so far is that we've bought the asset and started to put it into use at the beginning of the accounting period. Well, that's not always the case, right? Somebody could buy an asset in October. Not in January, but in October. And so at the end of that year, in December, they would only record 3 months worth of depreciation, not an entire year's worth of depreciation, okay? So let's look at our example right over here. Assume our machinery was purchased on October 8th, with our same asset cost and everything. Remember the asset cost of $10,000, salvage value of $1,000, and useful life of 5 years. And we use straight line depreciation. And so, but rather than purchasing this in January 1st and putting it into operation January 1st, we bought it in October and we started to put it into operation in October, okay? So if we look at this next page, we can go ahead and calculate that out. So I'll take my asset cost minus my salvage value divided by my useful life, which gives me my $1,800 per year, right? But we don't have it for the full year. So what I can do is take my 1,800 times my 3/12. Why 3/12? October, November, December. Okay? Which gives me $450. And then we know our journal entry to record depreciation, debit depreciation expense. In this case, this would be done on 12/31. Debit depreciation expense $450. Credit accumulated depreciation $450. Okay? So it's for part of the year. It's not for the full year. You can't do it for $1,800 because that's per year. So this is $450 for those 3 months. So you just adjust it for the number of months. All right? Or what you could do, another way you could do this, 10,000 minus 1,000 divided by 60. Why 60? Because it's total of 60 months because it's 5 years. And then you could take that amount times 3 because of 3 months, and you get the same answer. Either which way, same answer, okay? Let's talk about changes in estimates for depreciation. So sometimes the company can change their estimate of the salvage value and then their estimate of the useful life. And so that's what we need to talk about now. Okay? So the way that we do this, when this happens, what we'll need to do is to recompute depreciation for our current and future periods. And the way that we do this is we take the remaining book value, the book value, divided by the remaining useful life. Okay? So let's look at our example. Assume that the beginning of the asset's 3rd year, its book value is $6,400. Okay? At that time, it's determined that the machinery will have a remaining useful life of 4 years and that the estimated salvage value will be revised downward from $1,000, okay, down to $400. So this is our same working example that we were doing before, okay, where we took remember the asset cost of $10,000 and then the initial salvage value was $1,000. And that also the initial useful life was five years. But then after after 2 years, because this is after 2 years, in the beginning of the third year, so after 2 years, beginning of third year, we make a change. We change the useful life, and then we change the salvage value. So now what this does is for our third year going forward, we have to change our depreciation expense. Okay? So how do we do that? Well, we take our book value that still needs to be depreciated. We still have $6,400 of book value, right? That we have to depreciate. Minus my new salvage value divided by my revised useful life. Because remember, if this is at the beginning of the third year, the remaining useful life is 3 years. But we're saying our remaining useful life is 4. Okay, so we're extending it 1 more year. So divided by 4. Okay, and that's a 4. Gives us $1,500 per year. And so starting at year 3 onward through the useful life, we would debit depreciation expense $1,500 and then credit accumulated depreciation $1,500, okay, rather than the initial $1,800. In terms of reporting depreciation, so remember, we report our plant assets at cost because of the cost principle, and then we also show our accumulated depreciation. So we show our asset cost and accumulated depreciation on the balance sheet. So what we can, and then we show the book value. So we have our asset cost right over here, minus our accumulated depreciation. This is our book value. So we have our asset cost, total asset cost of $1,232,650, less our accumulated depreciation of $628,355, gives us our book value of $604,295. Okay, and again, we show our cost, and then we show our accumulated depreciation, and then the book value. And then remember, this is the book value, so you can see net after accumulated depreciation. That book value is the number that comes into calculating total assets. That's the number that comes into calculating total assets. Okay? All right, so I'm going to end this lecture video now. The next lecture video will cover quick check problems. Okay? Thanks so much.